Welcome back to Financial Market Insights for Traders. I'm Sophia, and today we are going to talk about inflation in a way that actually helps you make better decisions in the markets. Not the headline version of inflation, not the panic-driven version you see on social media, but the structural version, the kind that quietly shapes market behavior over months and years. Today's episode is about inflation regimes, and more specifically, inflation regimes explained and how to invest in each one. This idea is at the core of smart inflation regimes investing, and once you understand it, you start seeing markets very differently. Because inflation isn't just a number, it's a background condition, it's a regime, and regimes change how everything behaves. Most investors focus on whether inflation is high or low in a given month, but markets don't care about a single data print. Markets care about direction. They care about persistence. They care about whether inflation is accelerating, stabilizing, or becoming entrenched. That's why two economies with the same inflation rate can produce completely different market outcomes. When you start thinking in terms of inflation regimes instead of isolated data points, investing becomes less reactive and more intentional. So let's walk through this together. There are three broad inflation regimes that matter for investors and traders: low and stable inflation, rising inflation, and high or runaway inflation. Every market environment you've experienced fits into one of these buckets, even if it wasn't obvious at the time. Let's start with low and stable inflation. This is the environment central banks aim for. Inflation is predictable. Prices rise slowly. Businesses can plan ahead. Consumers don't feel pressure to rush purchases. Interest rates are relatively steady. When inflation is low and stable, uncertainty across the economy drops. That matters because markets hate uncertainty. In this kind of environment, companies can forecast costs accurately. Earnings are more predictable. Capital investment increases, and risk assets tend to do well. Stocks generally perform strongly here, especially growth-oriented companies. When inflation is low, future earnings aren't being heavily discounted, so investors are more willing to pay for long-term growth. Technology, healthcare, and scalable business models often thrive in this regime. Bonds also make sense in low inflation environments. Because inflation isn't aggressively eroding purchasing power, fixed income can deliver real returns. High-quality government bonds and investment-grade corporates often play their traditional role as stabilizers. This is why classic portfolio structures have historically worked best during long periods of low and stable inflation. It's an environment where staying invested, remaining diversified, and letting compounding do the work is usually rewarded. From an inflation regime's investing perspective, this is the easiest regime to operate in. You don't need constant adjustments. You don't need extreme positioning. Discipline matters more than cleverness. But inflation regimes don't stay the same forever. Eventually, inflation starts to rise. Rising inflation is where markets begin to shift and where many investors start making mistakes. Rising inflation doesn't usually appear overnight. It builds gradually. Maybe demand strengthens faster than supply. Maybe supply chains break down. Maybe wages start rising. Maybe governments stimulate aggressively. Whatever the cause, what matters is that inflation expectations start moving higher. And once expectations change, market behavior changes. Interest rates begin to rise as central banks respond. Bond prices start to fall. Equity performance becomes uneven. Volatility increases. This is the phase where broad market exposure becomes less effective and selectivity starts to matter. In rising inflation environments, not all companies are affected equally. Some businesses can pass high costs onto customers. Others can't. Pricing power becomes critical. Companies that sell essential goods, differentiated products, or commodities themselves tend to hold up better. Energy producers, materials companies, and certain consumer brands often perform well because rising prices flow through to revenues. Commodities themselves often become leaders during rising inflation. Oil, metals, and agricultural products are core inputs into the global economy. When inflation accelerates, their prices often reflect that directly. Inflation-linked bonds also become more relevant here. Instruments like TIPS adjust with inflation, helping protect real returns when traditional bonds struggle. Real assets start playing a bigger role as well. Real estate, infrastructure, and assets tied to physical goods benefit as replacement costs increase and rents adjust upward. This is where inflation regimes investing becomes more active. It's not about abandoning markets. It's about retaining exposure, about acknowledging that the environment has changed and adjusting accordingly. The biggest mistake investors make in rising inflation is staying positioned for a low inflation world that no longer exists. Then, in some cases, inflation moves into a much more dangerous phase: high or runaway inflation. This is the most disruptive regime, and while it's less common in developed economies, even moderate versions of it can wreak havoc on portfolios. High inflation is when price increases become rapid and persistent. Purchasing power erodes quickly. Confidence in monetary policy weakens. Interest rates rise aggressively. Currency values come under pressure. In extreme cases, people rush to spend money as fast as possible because holding cash becomes a guaranteed loss. Traditional investment strategies struggle here. Cash loses value fast. Bonds suffer as yields spike. Stocks often decline unless companies can grow earnings faster than inflation, which is extremely difficult when costs are rising everywhere at once. In these environments, investors often turn to assets with intrinsic value. Hard assets tend to hold up better. Real estate, infrastructure, and commodities retain usefulness regardless of currency value. Precious metals like gold and silver are often viewed as stores of value when confidence in money weakens. Global diversification becomes more important as well. Exposure to stronger currencies or economies with lower inflation can help offset domestic risks. Inflation regimes investing during high inflation shifts toward capital preservation. Liquidity matters. Flexibility matters. Risk management becomes the priority. Now, identifying which inflation regime you're in is more important than predicting the exact inflation number. This is another area where investors get tripped up. They focus on a single CPI release or headline number, but inflation data is noisy. What matters are trends. Is inflation accelerating over several months? Are central banks tightening or loosening policy? What are bond markets signaling through yield movements? Are commodity prices trending higher? Markets often reposition before official data confirms a regime shift. Expectations move first. Prices follow. Successful inflation regimes investing means watching those signals instead of waiting for certainty. And once you understand the regime, portfolio positioning becomes clearer. Low inflation favors growth assets and traditional diversification. Rising inflation rewards rotation toward commodities, real assets, and pricing power. High inflation prioritizes preservation and intrinsic value. This doesn't mean constant trading. It means gradual, thoughtful adjustment. Now, none of this works without the right tools. If you're trading or investing through changing macro environments, having access to a world-class, cutting-edge, user-friendly trading platform app can make a real difference. Crystal Ball Markets offers a platform designed for traders and investors who care about macro context, market structure, and execution quality. It's built to help you analyze trends, monitor conditions, and act with confidence. If you want to explore that platform, you can visit crystalballmarkets.com/platform. That's crystalballmarkets.com/platform. Education is just as important as execution. If you're still building your understanding of inflation, macroeconomics, and financial markets, Crystal Ball Markets also produces beginner-friendly podcasts focused on trading, investing, and macro themes. You can find those at iss.com/podcast/crystalballmarkets. Again, that's iss.com/podcast/crystalballmarkets. Learning how inflation regimes work, hearing real-world examples, and understanding market behavior through different cycles can dramatically improve how you approach investing. Before we wrap up, let's talk about a few common mistakes. One of the biggest is ignoring regime change. Investors stick with strategies that worked in the past without realizing the environment has shifted. Another is holding too much cash during inflationary periods. Cash feels safe, but inflation quietly destroys its value. Overconcentration is another risk. Relying on one asset class makes portfolios fragile when regimes change. And finally, reacting emotionally to short-term data. Inflation is a trend, not a headline. Avoiding these mistakes often matters more than finding the perfect trade. So here's the takeaway. Inflation regimes shape markets more than almost any other macro factor. Once you truly understand inflation regimes explained and how to invest in each one, you stop reacting and start positioning. No regime lasts forever. Markets rotate. Leadership changes. The investors and traders who succeed over time are the ones who adapt early, stay diversified, and combine education with the right tools. Inflation doesn't have to be something you fear. With the right framework, it becomes something you manage. That's it for today's episode of Financial Market Insights for Traders. I'm Sophia. Thanks for listening, and I'll see you next time.